Okay, I want to talk to you about traded options because they're a really good way of getting the most out of the markets. And it's quite difficult to do it without a board or something to write on, but I'll give it a go anyway. A traded option gives you the right, but not the obligation to buy an underlying asset. Now, in most cases, that asset is a share or a share index. So let's take the FTSE 100, for example. You can buy a traded option that will give you the right to buy the FTSE 100 at a particular price or sell the FTSE 100 at a particular price. So let's say you think the FTSE 100 is going to go up in value. You can buy a traded option that will have certain characteristics. It will have a strike price and it will have an expiry date. I'll take those things one at a time. The strike price is the price at which you can cash in that option. So if the FTSE 100 is trading at 6,500 and you think it's going to go up, you could buy an option that would have a strike price of 6,700. Now, if the FTSE 100 went beyond 6,700, if it went higher than 6,700, your option would start to have an intrinsic value because it would give you the right to buy the FTSE 100 at 6,700, and obviously you'd then be able to sell it at the price that the FTSE 100 was at that moment in time. If the FTSE 100 was higher than 6,700, let's say that it's at 6,800, then that option has a nominal value of 100 points, whatever that means. And we'll come to that in a minute. So you have a strike price, that's the first thing. And you also have a time value to an option. Now what that means is that you buy an option. Now you can choose when the expiry of that option is. It's not like a share. Options don't last forever. They have a certain time limit to them. So you might be able to buy an option that expires in a month. And what that means is that after a month has passed, that option doesn't exist anymore. Now, obviously, if you want to buy an option that lasts a year, that's going to cost you more than buying an option that is only going to last a month. I mean, if you take it to an absurd level, if you bought an option that only had an hour left on it, you can see that would cost a lot less than an option that's got a year left on it. So typically, you would buy index options, and it varies with other types of options, but options on the FTSE 100 expire monthly, and you could buy them a month, 2 months, 3 months, 4 months, 5 months in advance. So you've chosen the strike price. You also have to choose the time frame within which you think the market is going to move. So let's go back to the example that I mentioned before. The 6,700 the 6,700 call, and we'll come to puts and calls later on. The 6,700 call, which means that you think the market's going to go up. The call gives you the right to buy the market at a certain price, and a put gives you the right to sell the market at a certain price. So if you think the market's going to go up, it's currently 6,500, you think it's going to go up beyond 6,700, you'll buy a call. So you've chosen your strike price of 6,700. You now have to choose the expiry date. And you think this is going to happen within, let's say, 3 months. So you would buy a call, which gives you the right to buy the underlying asset, which in this case is the FTSE 100. And you would buy it at 6,700 because your analysis or whatever it is that whatever that's led you to this conclusion that the FTSE 100 is going to be above 6,700, you choose 6,700 as your strike price. and you think it's going to happen within 3 months, so you choose a 3-month time scale. So you're paying for the strike price, but because the strike price is higher than the current value on the FTSE 100, there isn't much value in that strike price. If you were buying with a strike price of 6,000 and the market was currently at 6,500, then obviously you'd have 500 points of value in that price already. But because you're choosing a price which is higher than 6,500, where the current level is, then there's no intrinsic value in terms of the strike price. It's called out of the money. However, there is a value in terms of the duration of the contract of the option, because that time value gives the opportunity for the market to move in your favour or against you, but that's why there is a time value. So options have a time value and they have an intrinsic value based on the strike price. And a lot of complex analysis can be done on those variables, but just for a basic explanation, that is what governs option prices. It's the time value and the strike price. Now let's say after a month the FTSE 100 is trading at 7,000. You have a strike price of 6,500. So that means you have a contract that gives you the right to buy something at a lower price than it currently stands. So you can see why that would have a value. And that's called a call because you're buying it. Conversely, if you thought the market was going to fall, then you could buy a put, which would give you the right to sell the FTSE 100 at a particular price. And let's say the market did fall and you had a put that gave you the right to sell the market at, say, 6,500, and the market had fallen to 6,000. Then again, you can see how that has a value to it, because you have a contract that gives you the right to sell something at a higher price than it actually is in the marketplace. And that essentially is a very basic explanation as to what a traded option is. Traded options can be used for all sorts of types of trading. They're called traded options because they're traded on an exchange. You can get other types of options that aren't traded on an exchange, but they're not really open to private investors. So typically, if you're a private investor and you're looking at options, you'd be trading using traded options. You can also spread bet on option prices, which is sort of taking it a step further. But the great thing about options is they're not just speculative. So, for example, if you had a portfolio of stocks and you were worried that there was going to be some short-term market volatility that might lower the price of or the value of your portfolio substantially, but you also thought that your portfolio was reasonably sound, you could use options as an insurance policy that would allow you to profit from the fall, if it were to happen, in the underlying securities that you have, as long as you made sure that the options that you bought correlated with your portfolio. And were the market to fall, were the price of those shares to fall, your options would go up in value, and you could profit from the rising price of the options, which would offset the loss of the underlying portfolio. And the reason you might want to do that is because it can be costly to completely liquidate your portfolio that you want to hold long term anyway. And so you can use options as that type of insurance policy. You can also combine options, because the way I've explained it so far, I've talked about the purchase of options. I haven't talked about writing options, and that would be for another video. But you can combine purchasing options and writing options to give you various different options spreads, and we can talk about those, and you can Google them if you like. There's all sorts of different ones. For example, there's a butterfly spread, which I can't explain right now without showing you on a piece of paper or writing it down, but you can Google it and see how it works. But before you do that, if you want to look at the next video, where I'll talk about writing options. But what I've explained in this video is what an option is, a traded option, when you buy it, rather than write an option. So you open the transaction by buying a contract, and then you sell that contract, or let it expire, depending on what you want to do. But that type of transaction is different to writing options, which is a bit like underwriting an insurance policy. Not quite, but there's a sort of a bit analogous to that. So, what do we take from this video? Options are a very useful way of insuring your portfolio. They're very flexible. They allow you to profit from various different market situations if you combine them in different ways, and we'll look at different ways of combining them in other videos. They have two important, when we're looking just at the basics of options, there are two important variables. There's the expiry date, which affects the value of the option, and there's the underlying strike price, or there's the strike price rather of the underlying security. So that's what you need to remember. It's the time value and the strike price, and those variables are used with a formula called the Black-Scholes model, or Scholes, I'm not quite sure of the pronunciation, to price options. There are other ways of pricing options, but that's the sort of the fundamental way. That's the one that's used a lot. I'm sure a lot of people also have other algorithms, but if you're going to learn about options pricing models, then Black-Scholes would be a good place to start. I hope that's been of some use. If you have any questions, let me know, and I will be posting more videos about options later on.